This question tests understanding of the sequence of preparing the master operating budget, a fundamental concept in management accounting and budgeting. The master operating budget consists of several interrelated budgets that must be prepared in a logical order, because each budget provides information needed for the next budget. The key phrase is order in which budgets should be prepared. Students should remember that budgeting begins with forecasting sales, revenue, because expected sales determine how many units must be produced. Once production requirements are known, management can estimate the amount of direct materials needed for manufacturing. Thus, the budgeting process follows the operational flow of the business from sales, production, resources required for production. A. Production budget, direct material budget, revenue budget. Incorrect. The production budget depends on expected sales, so it cannot be prepared before the revenue budget. B. Production budget, revenue budget, direct material budget. Incorrect. Revenue forecasts must be established first because production planning is based on expected sales demand. C. Revenue budget, production budget, direct material budget. Correct. The revenue, sales, budget is prepared first because it estimates customer demand. Next, the production budget determines how many units must be manufactured to satisfy sales and inventory requirements. Finally, the direct material budget calculates the materials needed to support planned production. D. Revenue budget, direct material budget, production budget. Incorrect. Material requirements cannot be determined until the production budget specifies the number of units to be produced. Correct answer. C. Revenue budget, production budget, direct material budget. Exam tip. The master operating budget generally follows this sequence: sales, revenue, budget production, budget direct materials, budget direct labor, budget manufacturing, overhead budget, ending inventory, and cost of goods sold, budget selling, and administrative expense budget, budgeted income statement. This question tests understanding of budgeting methodologies, specifically zero-based budgeting, ZBB. Organizations can prepare budgets using different approaches, such as incremental budgeting, performance budgeting, program budgeting, and zero-based budgeting. Each approach has a different philosophy regarding how budget amounts are determined. The key phrase in the question is, requires a manager to justify the entire budget for each budget period. This indicates that managers cannot simply carry forward the previous year's budget. Instead, every activity and every dollar requested must be evaluated and justified from the beginning, as if the activity were being undertaken for the first time. This characteristic is unique to zero-based budgeting, ZBB. Students should distinguish zero-based budgeting from incremental budgeting, where the previous year's budget serves as the starting point and only incremental changes are analyzed. A. Performance budgeting. Incorrect. Performance budgeting links resource allocation to performance measures, outputs, or outcomes, emphasizing efficiency and effectiveness. It does not require managers to justify every budget item from zero each period. B. Program budgeting. Incorrect. Program budgeting organizes expenditures according to programs or activities rather than departments. Its focus is on achieving program objectives, not on rebuilding the entire budget from scratch each year. C. Zero-based budgeting. Correct. Under zero-based budgeting, ZBB, every budget period begins from a zero base. Managers must justify all planned expenditures, regardless of whether they existed in prior years. Each activity must demonstrate its necessity and cost-effectiveness before receiving funding. D. Incremental budgeting. Incorrect. Incremental budgeting starts with the previous year's budget and adjusts it for expected changes such as inflation, growth, or new activities. It does not require complete rejustification of all expenditures. Correct answer. C. Zero-based budgeting. This question tests understanding of budgeting methodologies, specifically the characteristics of zero-based budgeting, ZBB. Organizations can prepare budgets using different approaches depending on their planning objectives and management philosophy. The question describes a situation in which every budget item must be reviewed and justified, regardless of whether it was approved in previous years. The key phrases are: will not automatically approve operating budget items, all operating budget items, will need to be justified, full in-depth review. These statements indicate that the company is not using last year's budget as a starting point. Instead, every expenditure must compete for funding and demonstrate its necessity and value. This is the defining feature of zero-based budgeting, ZBB, where managers begin each budgeting cycle from a zero base and justify every activity and expenditure. A. Activity-based budgeting. Incorrect. Activity-based budgeting, ABB, develops budgets based on the activities required to produce products or services and the associated cost drivers. Although ABB focuses on activities, it does not require every budget item to be justified from scratch each period. B. Zero-based budgeting. Correct. Zero-based budgeting, ZBB, requires managers to justify every budget item during each budgeting cycle, regardless of prior approval. Previous budgets are not automatically carried forward, making ZBB particularly useful for controlling costs and eliminating unnecessary expenditures. C. Project budgeting. Incorrect. Project budgeting is designed for specific projects or capital investments, focusing on project costs and timelines rather than reviewing all organizational operating expenses. D. Flexible budgeting. Incorrect. Flexible budgeting adjusts budgeted costs according to changes in activity levels or output, but it does not require managers to justify every expenditure from zero. Correct answer. B. Zero-based budgeting.